Um, Albert is everywhere. Okay. If you've just joined, feel free to introduce yourself in the chat. For most of you, the chat will be a bubble that, or a window that appears on the side of your screen. You can find it at the bottom of your Zoom window as well. Thank you so much for making time for this morning. So I'm Laura Bueller. I'm the Executive Director of C100. I think a lot of you know us, but seeing a lot of new names and of course phone numbers dialing in as well. And so thank you so much if you came because you heard about it from a founder friend or from Mike or Jeff or Janet. Thank you so much for joining us. So this morning, we're going to have a conversation that is the second of many, we hope. This conversation is about accessing capital in a sudden downturn. So we know that there are a lot of very real stresses and fears right now and confusion. Nobody has a crystal ball. And so we're trying to pull together the C100 community to put together these roundtables so that you all have access to some thought partnership and some peer-to-peer connections as you all navigate this for your own companies, which is, of course, I think the word is unprecedented times. So thank you so much for joining us, and please do participate. For those of you who aren't familiar, C100 is a member-supported, not-for-profit. We are headquartered in San Francisco, California. We have members across all the major technology hubs in the US, Canada, and beyond. Our members, which are individuals and organizations, really represent a preeminent global community that is committed to supporting, inspiring, and connecting the most promising Canadian entrepreneurial leaders. We aim to support all of you, Canadian technology leaders, through mentorship, investment, partnership, and talent. Careerlist is our co-host today, and Careerlist is a recruiting platform that connects employers with talent through a network of independent recruiters. They're headquartered in New York City. Their CEO and founder is Canadian and a C100 member, Michael Scissons, who is our moderator today. Mike is based in New York. He's an entrepreneur and an investor and has seen each side of this table, the proverbial investor table. And so he'll be moderating and introducing our other panelists. You all can guess where Michael is originally from based on his background image, which he'll tell us about when he introduces himself. So just a quick note about Q&As. So we're going to go through about 15 or 20 minutes with some moderated questions for our panelists. But those of you, I know all of you are going to have a lot of questions to ask. And so we're going to ask that you actually put those in the Q&A. And that's different than the chat where you're all introducing yourselves now. So at the bottom of your screen, you can see a Q&A button, and that's where to enter your Q&A. It would be helpful to us if you can, again, state your name and your company so that we can easily call on you. We are new at the webinar format, and so we're going to do our best to switchboard and unmute you to ask your own question. If it doesn't work out, I and Michael will moderate those questions for you. We just ask that you keep it really succinct and tight. We do have a lot of people joining today, and we want to make sure that we get through as many questions as possible. So without further ado, I am going to be turning it over to, sorry, I should have mentioned this. We are recording this session, and we'll be sharing it after the fact later this afternoon. For your reference. And so please do feel free to be candid, but do know that we are recording the conversation. Okay, I'm going to hand it over to Mike Scissons. Thank you so much for doing this with us, Mike. It's been an incredible resource so far, and really looking forward to today's conversation.
Thanks, Laura, and really excited to have Jeff and Janet here today to share their wisdom. As Laura mentioned, I'm originally from Saskatoon. I'm not actually from Viceroy, but for some reason I couldn't find the Saskatoon grain elevator. So if any of you have photos of that on your phones, you feel free to send them to me, because I can update my background. I'm looking forward to today's discussion. My first company, went up and definitely went down. The second company did much better, and this is my third. So I think going to try to lead today's conversation in a really concise and helpful way. And excited to have two amazingly talented people with us. Janet, who is currently held up in a room in a house in Toronto. She's been an entrepreneur since she was a teenager, and I've known Janet now for probably 5, 6, 7 years in a lot of different ways. Janet, maybe if you could do a quick introduction of yourself and what your favorite Tragically Hip song is, and we can go from there.
Okay, great. First of all, it is great to be here. So good to see many familiar names on the chat. So welcome today. Great to have you here. I am managing partner of Real Ventures. Real Ventures is an early stage venture capital firm focused on leading seed stage rounds of Canadian-based companies. And my favorite Tragically Hip song, I will come back to that. And in the meantime, I will say something, I guess I'll say it's a beautiful day in Toronto. It's sunny and it feels like spring is coming. And so it was great to get out in the fresh air for a run this morning.
Great. And Geoff is founder and managing partner of Bedrock. He was named one of the top 100 venture capitalists by CB and the New York Times, and previously was at the Founders Fund. He is currently in an undisclosed location. Held up, but Geoff, I'd love just give a really quick introduction, and if you have a favorite Tragically Hip song, what that is. It's always seems like a regular C100 dinner thing, and since we're not having dinners anymore, I guess we got to do it over Zoom.
Well, yeah, I'll start with the last question. I'm a huge hip fan. I actually went to school in Kingston at Queens, and used to see some members of the Hip hanging around. Wheat Kings by far is my favorite, and in particular, there's a live recording of Wheat Kings that you can download on Spotify that I highly recommend. I'm not quite sure when they played it, but it's absolutely amazing, and I love the Hip. Just quick intro, founder of a venture capital firm called Bedrock. We manage around $500 million, founded the firm around 2.5 years ago. We're based in New York, but I previously spent almost a decade in San Francisco and Silicon Valley. The latter half of that period, about 5.5 years, was spent as a partner at Founders Fund, which is a Silicon Valley VC firm. And then prior to that, I was an entrepreneur myself. I built a SaaS business from Calgary originally, but have been in the States since 2005.
Great. And Geoff, maybe we'll start, with you. Obviously, in the last, 4 weeks, the world has changed substantially. How are you telling your companies now to be thinking about capital generally?
Let's see. It's always a company-specific type situation, and so it's sort of a time where there's not sort of a one-size-fits-all piece of advice that I can apply to sort of every company in our portfolio. I'd say sort of the common theme that we've seen is that basically financing rounds have come to a sort of a standstill unless there's a pre-existing long-standing relationship between the entrepreneurs and the folks that are contemplating investing. And so sort of the whole, in this context today, the whole idea of like trying to build a relationship with a VC or an angel investor that you don't already know, with an eye toward raising a round. We actually don't think that's a good use of time right now. It's sort of like the deals that are getting done are deals where there's sort of a long-standing prehistory with the investors and the entrepreneurs. More broadly, I'd say that because we are in just a completely unprecedented era, this doesn't rhyme with anything that's happened in the past. It's sort of, I'd say there's sort of like 3 shocks at once. There's the COVID-19 shock, which is a global shock. There's the oil shock, which is largely a global shock. And then there's the COVID-19 shock is a health shock, and then there's the economic shock caused by the chain reaction. And so it's sort of, 3 shocks. No one knows how it's going to end. It's probably going to be many, many months, quarters, potentially years before we figure out how this sort of resets the system. But all of that is a long-winded way of saying, really what matters the most is runway in the bank. And so I think that for the last, ever since I became a VC in 2012, capital has just been abundant. And, more often than not, for a company that had either even a modicum of traction, to be able to raise capital, and that's very different. And so it's really all about just how do you maximize your runway to live as long as possible. And I'd say that runway, capital in the bank matters even more today than product market fit. So I was a bit long and rambling, but the short answer is I don't have any great one-size-fits-all advice, but I think really trying to maximize for capital in the bank and cutting burn is the right mode to be in for the majority of companies today.
And Janet, how do you, what's the same, what's different for you? How are you seeing, you work with a lot of earlier stage companies and as they grow, obviously as well.
Yeah.
What's the general advice you're giving? And is there, more specific advice that, you kind of see companies based on a couple different categories?
Yeah, so I think a couple of things. First of all, ideally the company, you can do your financials such that you have 18 to 24 months runway where possible. And so the question is, okay, how do I, as a young company, how do I get to 18 to 24 months? Obviously at a high level, there's your revenue and there's your costs. And so I'll talk a little bit about each bucket. In terms of revenue, the good news is that we're seeing some companies that are actually benefiting from this situation in terms of their growth. So some areas that are growing, where we see in our portfolio companies, anything related to telemedicine, remote work, electronic payment, online education, supply chain in some situations, if it's helping identify new sources for manufacturers, those type of companies are doing very well. And then you have, some companies on the other end of the spectrum, that we have in our portfolio that are either in the restaurant industry, transportation or travel, hospitality, live events, and those are getting hit. So, the first thing is to understand how your revenue is being impacted. And while the buckets I talked about is fairly clear, what I find a lot of companies that are selling into enterprise, there's still a question mark out there. What's going to happen by enterprise sales cycle? And so for those companies, I would say, hey, you really need to understand what are the leading indicators, really get on top of understanding how your customers are going to react so that you can understand the impact on your revenue. So step number 1, understand impact on revenue. Number 2, once you do that, is really think about, hey, do you need to reposition your company? Do you need to rethink your value proposition in this time? Do you need to rethink your pricing? And so a couple of examples of that, for instance, we're invested in a company called Plum. They have psychographic tests or they're testing to help companies identify which people they should be hiring. So in this environment, they've shifted and they're now helping teams work most effectively in a remote environment. Or we have a company called Sonder in our portfolio. With the hospitality industry going down, their short stays business has significantly diminished, but they have shifted and they're focusing on 14-day plus stays, which are actually growing as university residents shut down and other factors. There are people who are looking for alternative houses. An example of a pricing option is one of our companies is Code League in the employee health benefits space. They are offering enterprises a 90-day free trial of their platform. So just, examples of that. So that I think all speaks to the revenue line. And then the other thing is the cost line, really looking at how can you reduce costs if necessary. There's a lot of government programs that are coming out both in the US and Canada. Several of those are just evolving on a day-by-day basis as more information comes out, but looking at, hey, what can you do? What can you leverage there to reduce costs? Do you need to reduce headcount and or reduce salaries? A lot of our companies are taking cuts, particularly at the executive level, in order to save money. So those are sort of the top line and bottom line. And then because things are changing so quickly, we are for a lot of companies that are getting hard hit, we're reviewing those numbers on a weekly basis and continually revising it to say, okay, what more do we need? What more can we do to extend the runway? And then I guess actually the final piece is the capital component. So there's some government programs. I know in Canada, BDC has come in with a matching program. And so we're helping our companies tap into those. And on that point, you know, just building in terms of what Geoff has said in terms of raising new capital, VCs right now that have large portfolios are 100% focused on working with their current portfolio. So those are not really great people to target. Angel investors are generally scared off and not willing to invest. Where we have had some success with our portfolio companies that are continuing to make traction over the last 2 weeks are VC firms that have recently raised their first fund. Those are great targets because they don't have a large portfolio, they have funding, and they are seeing this as, hey, here's an opportunity for us to invest in companies and get in at a more reasonable valuation on companies that have that are long-term great companies with great teams.
Yeah, totally. That last insight is a really important one. I think targeting firms that have just raised their first fund, that is a very good insight.
Yeah, that makes a lot of sense. I hadn't actually, thought of that. I've been on the other side. I've been getting, probably gotten 10 inbounds in the last week, and it's weird because the inbounds kind of feel different now than they did 2 weeks ago. It's kind of like, really, this probably isn't the best time to be asking for something, and the same for sales, right? You're getting a lot of SDR outreach right now saying, hey, you want to buy whatever? It's like, no, I really don't. Like, I'm up here in the third floor attic of my house, my dog. I'm not interested in buying X unless it's something that's going to be helpful. How do you think, outside of kind of communicating with those first funds, if a founder wants to be playing a longer term game now, which it really is, as we kind of get through what I'll call, this is a pause era on a lot of fronts for a lot of companies, they want to come out of the pause stronger. How should they think about building relationships with you now in a way that is, what should the playbook around information and sharing or transparency be now to kind of set the stage for 6 months from now or 9 months from now when kind of you're out of this phase and into the next one?
I have a somewhat against the grain view on this, I would say. And so I'd say part one is just addressing the inbounds that you, Mike, are getting from what I would assume would be sort of, VC associates sort of inbounding you. So I think basically we're in an environment where there are a lot of people that are employed in the VC industry at a pretty junior level, and they feel like they need to be doing work because they're getting a paycheck and they're sitting at home. And so you have this sort of environment where you've got all of the general partners are just completely portfolio triaging. Like on my end, I'm nonstop triaging with my portfolio companies, working with them to fight fire. It sounds like Janet sort of similarly trying to help however she can. And so if you're a GP of a fund and dealing with LPs, I'm the founder of the firm. So like we have LPs that might not be able to make capital calls because they were like overexposed to certain elements of the economy that have really crashed. So it's just insane triage at the sort of GP senior partner level. And so if any VC is reaching out proactively, unless they're from a new fund, they're likely pretty junior and just trying to do work, and they'll just waste your time, which dovetails into my somewhat contrarian view here that actually entrepreneurs just shouldn't be focused on relationships with VCs right now at all. So if you're an entrepreneur, I think you just should not be, if you have money in the bank, it's like your existing investors matter. And then I think sort of working on relationship building with prospective future investors, it's just not an optimal use of time for you or for them, because psychologically, nobody has the psychological bandwidth to actually focus and engage on actually building a new business relationship at this moment in time. I think there's just too much chaos, too much that people are processing. We don't have the processing power to actually sort of engage in the way that one would need to build a new relationship with an investor. So I actually just don't think that founders should be doing relationship building at all, and for the next indefinite number of weeks.
Janet, do you want new friends?
So I
Geoff
would
wants
say,
no
I
new
think that
friends.
I don't want any new friends. I'm enough friends.
I can to emphasize what Geoff said, like, I'm working all the time on our portfolio, existing portfolio, our team, and our LPs, like every day. It's those three constituencies, and that's what I'm focused on every day, all day. That being so, unless, as I said earlier, it's a new fund, well then, yeah, that's good. Other than that, I think in terms of reaching out to partners at this time, not really the best time. Now, I'm hoping that like maybe in 3 or 4 weeks, maybe things will quiet down a little bit. So in terms of, hey, if you're a founder and you're thinking, hey, when do I reach out to a partner at a firm, and how do I approach them? I would say one, probably give it another couple weeks. Hopefully things will at least not be as firefighting then. Secondly, be very clear in terms of why the VC should talk to you now. So, it's the same thing, the same principles as always, that you need to have a unique insight in terms of why that partner should engage with you. What is your unique insight? What are you doing that is going to build a huge business? Why do you matter? And I think that is particularly important in this time, and also answering the question, why now? So figuring out, and the why now, by the way, it can't be because you ran out of money. But you have to have a compelling reason about why you as a partner should be engaging with me as the founder right now. I think the other point that I would add is, at this time, leadership is more important than ever. In a crisis, leadership's always important, but in a crisis, it's particularly important. So I also think in those reach outs that it is critical to highlight your team and the team's ability to get through this situation.
Great, Laura. Do you want to, in terms of, do you want to go into Q&A at this point? Because I see there's like a growing list. Do you want to work through that, or do we want to go?
We can do a bit of both, Michael.
Okay.
We do have, we're going to start actually with a question from David Steckel, who is president and founder of Setter. And we're going to do our best to unmute David here so that he can ask his own question.
Look at this technology. We're getting better every week at this.
Yeah, and a few people have asked the same question, and so we'll have, David was the first to the punch, so we'll have David just say who you are, and if you don't mind repeating your question.
Good afternoon, everybody. My name is David Steckel. I'm the founder and president of Setter. We take care of your home so you don't have to, but this new market is not, we're expecting not to have any revenue for the next 3 months, and the next 6 months, we're not expecting to be going into anybody's home at all. So, 80% revenue drop from 3 to 6 months. We have currently 12 to 18 months of runway, but given the situation that's happening and expecting a 2-year turnaround, if not 4 years, to getting back to normal, should we pull our venture debt facility from SVB? Typically, our investors and VCs in general haven't been very enthusiastic about venture debt. And I'm just wondering, has the consensus changed at all? Should we pull our venture debt now, even if we don't need it, just to make sure that we have cash in the bank?
I'll take a stab at that. 100%. As a VC, we obviously, particularly when there are 3 concurrent macro crises happening at the same time, it's sort of suboptimal as a VC for a company to draw down a venture debt line, given it's more likely that we'll lose our investment. So the incentives are very misaligned between you and the VCs. But that every day that passes, that the line is more at risk. And so I would absolutely draw it down. We've seen companies over the last 3 weeks in our portfolio draw, I'd say, over 200 million in venture debt. Just sort of offensively, not needing the money, not anticipate that they'll be needing the money. And, maybe it's sort of overly reacting. These are mostly growth stage, later stage companies, but I would advise you to take the money, to draw it while you can. Based on what you said about your business, it would make sense to just be in very much a runway extension mode to the degree you're able to do that through venture debt.
Janet, you look more mixed.
I don't know. I think it depends. I mean, I'm not sure. By the way, David, it's great to hear your voice. Hope you're doing great. I think it depends on the 12. I mean, it's always an depends answer, right? It depends what are the terms that are associated with that. How much will that, if you have to start paying interest, how much will that impact your burn? What are the costs associated with that?
What are their call
It
rights?
was unclear whether the 12 to 18 months runway was pre or post these changes. So anyways, in the interest of time, I don't want to sort of get into that, but I would just say, I think what you've got to do is look at, I don't think it's an easy black and white. I think you need to look at what is the implication on that. Talk to Silicon Valley Bank. I actually know that they're coming out with a new program. I've got an email in my inbox that I haven't read yet, but really understanding what are the terms, what are the costs, and looking at that.
Great, thank you both for that. Michael, I can actually triage another one out here because we have another question lined up that we think is a really good one. And the question comes from Thomas Schneider, the CEO of Trip Concierge. It sounds like his business is in a little bit of a different position and maybe a bit of a positive position, but he has a specific question around travel businesses. And so if we can, again, let's try to unmute Thomas Schneider.
All right. Hi, it's Thomas.
Hi, Thomas.
So we are one of the few travel businesses that has actually quadrupled its subscribers base over the last 3 months just because of all this panic, people not being able to reach their airlines and Expedia. And that's because we deal with crisis business travel. And upstream capital for travel, was quite tough to start with. And I think that's going to be impossible. So I was wondering whether you guys had any thoughts on how a travel business that's actually doing well at this point in time could potentially stand out to investors, so they don't throw our deck out before they even start looking at it just because it's travel.
So if you want, I'll go. Thomas, great. Thank you very much for the question, and congratulations on the success of your business. I think you need to grab, whenever you're reaching out to investors, you need to grab them in the first sentence. And so first, in your opening line, and I think that maybe the way to do that, a simple way, is don't talk about it. Don't lead with travel. If people are going to have an allergic reaction to travel, lead with, you can't sound too spammy, but basically, hey, our business is up X% due to COVID, or I don't know, something like that, right? Lead with something maybe other than travel. But I think the challenge will be, how do you make sure that people don't think, hey, this is a one-time blip in your business, and that you actually have a long-term business. Hey, it's great that you're doing well now, but is that what happens in 6 months or 8 months or 12 months when the crisis is over?
So I'd like to ask a follow-on question that has to do with, it's one that's been asked by one of our question askers, but she's got multiple, and I think it's on a lot of people's minds here. How do you think about the early stage investment lens and the metrics that early stage investors are going to be looking for given the COVID-19 crisis? That is to say, do you think there will be, where do you think the focus will balance between growth and product market fit, finding it early versus building a sustainable business model for the long term? What are your thoughts on how the conversation might change, if at all?
I'll take a quick stab at this. And so again, when you say sort of the early stage funding environment, that's a really broad sort of term. And so you sort of have to look at it on a sector by sector basis. And so I would say, you know, from an early stage standpoint in digital health, in hardware related to you know, medical devices, in biotechnology, working on therapeutics, I think actually valuations will go up at the early stages, and there's going to be a rush of interest to sectors that, like, traditionally there hasn't been as much capital relative to, like, consumer and enterprise software, in digital health, in medical devices, and sort of really, you know, sort of speculative biotech. And I think actually we're going to see a huge influx of capital into those areas, and it's going to be sort of a golden age for those areas. Conversely, I think that if you are if it's sort of an early stage enterprise software company, which, and you know, enterprise software has sort of been the sector that has worked sort of most over the last, I'd say, if you sort of look at the companies that have most worked over the last 4 or 5, maybe even 6 years. I think the last huge consumer hit was kind of a, you know, it was maybe Snapchat, Lyft, Uber, sort of, you know, Instacart was sort of the last ones. Airbnb, and Sonder, and credit to Janet. Hopefully that one makes it through this. In any case, if you're sort of an enterprise software company, I think the valuation is going to come way down, particularly if you have a sales motion that requires actually meeting customers in person. If you have a sales motion that requires multiple buyers. So I think sort of enterprise software, huge correction on valuations, probably going to be like 75% off. And so really what matters is just, can you get money to give you enough time to get to sustainability? And by sustainability, I mean actually profitability, sooner than historically VCs would have wanted you to get to profitability. So our mantra as VCs is always like, just focus on growth, don't worry about profitability. Like, if you build a huge business, product market fit, you're gonna get to profitability. I think we're now in a 180-degree different reality for enterprise software, where you want to sort of have enough money to get to product market fit, to get to profitability. And then once you're sort of ramen profitable, you can maybe assess, okay, how can we pull some levers for growth? But I think enterprise software is a sector that's just gonna really be negatively impacted here, unfortunately. And then consumer, I think, will be sort of, there'll be sort of a tale of two cities in consumer early stage. You know, so I'd say there will be a sector of early stage consumer businesses that I think are just like basically borderline unfundable at this point. And so, you know, like if Lyft was started today, I led the first financing round in Lyft. If Lyft was being founded today, no one would invest in that company. And there's sort of anything where there's sort of like intersection of like real world software that enables like IRL things that are non-essential. Those companies are not going to be fundable. If Airbnb was being founded today, no, that company would not be fundable. And then there's this, you know, other city in consumer internet of all these new ways that we need to now connect virtually, work virtually, and collaborate. I think there's an opportunity for new consumer social networks. I continue to believe that to be true, that there is an opportunity to disrupt the sort of incumbent social media players. I think there's a lot around sort of the intersection of consumer and healthcare that is going to be very interesting. And then yet at the same time, I think we are just in a valuation reset mode, and so it's really just about, can you get money somehow, and really shouldn't even really care that much about the dilution is my personal bias at this moment in time.
Thanks. And then, I mean, just to add to that, I would, you know, 3 points in turn I would add to the discussion. First of all, the way that we as early stage investors often look at a company is we look at 3 different aspects. We look at the team, traction, and vision, or is this a big idea? And I think you need to be strong in at least 2 of those. And so what I mean by that is, for instance, if you have a super strong team and you've got an awesome vision, you probably need less traction. So, and you can play around with any of those. And so I think that that motto still holds and is a way of thinking about, hey, am I seed ready? I think that investors will look for more on those three things because they will be more choiceful in terms of how to make investments. Seed stage investors will understand that they may not be able to go out and raise their next fund in 2 or 2.5 years, and therefore they're going to stretch out this time in which they make investments, and therefore they will not be making as many investments in any given time as they may have previously. So, I mean, that's one thing to think about. I think the second point is your business recession proof or ready for anything? So there's a lot of people who are saying, hey, when this is solved, when we all go back, first of all, will we ever go back to normal? And second, and will there be a recession, or what's going to happen? And so if you have a model that is, can sustain sort of any economic situation, then that will obviously be a very good thing. And I think the third thing to think about is whenever we lead a seed round for a company, we always work through with the company, okay, how much are you raising in this seed round? And do we think that this money is going to get you far enough so that you will be able to raise a Series A at least 6 months before you run out of cash with a little buffer in there? And so now what's going to happen is, the good news is probably your cost of running your company will have gone down because of the amount of talent that's available, and wages for engineers and things are going to come down. But the reality is people will say, hey, okay, now those milestones that you need to hit in order to reach your Series A are probably going to be higher, and therefore you're going to either need to accomplish, you're probably going to need to accomplish more with this amount of money. So again, it's rethinking whenever you go into seed round, am I raising enough money to get me to the point where I will have hit all my Series A milestones at least 6 months before I run out of money? That's a calculation that we've always done, but now we're going to be doing that calculation with a different set of metrics in mind.
Awesome. So we're going to be moving on to, thank you, Janet, to another couple questions here. Before we do, we're seeing a lot of questions come in related to the government programs, largely in Canada, but of course in the US as well, which are highly relevant. But we are going to be leading one of these sessions on that topic specifically in 2 weeks. So we're going to be working with the BDC to bring you and Ask Me Anything on that topic. So we're going to stick to private capital in this conversation, and I encourage you to tune in 2 weeks' time for the BDC conversation. One more note to the next question askers. We are going to mute you after you ask your question. So any further follow-up or follow-on questions that you have, we encourage you to have those one-on-one or reach out by email. Right now we're going to hop over to Julia, and Julia and all following question askers, if I could ask you just to say your name and where you're dialing in from, and then ask your question as it's written so that we can keep it really succinct and short. Thank you.
Hi there, this is Geoff Lewis from Toronto. I was just wondering.
All right, Julia, we're going to try one more time to unmute you. Your line is really unclear, so if you can try to speak loudly.
Can you hear me now?
Yes.
Okay, sorry. Hi, this is Julia from Toronto. I was just wondering the difference between the investment landscape in Canada versus US. So it's been common knowledge in the past that Canadian investors are more risk adverse. Do you think COVID will change this given the lower valuations? Yeah, I'd just love to hear your thoughts on the geographic differences.
I think we kind of get the gist of it. So I'll reframe the question, Julian. Hopefully I do an okay job. But the question is differences between the investment in Canada and the US. As Canadians, have we been more risk adverse? But do you think this is going to really change that and lower valuations as part of that? Are there any kind of jurisdictional differences that you're going to experience here with the with this type of crisis or recession in the past? We've seen Canada behave differently than US investors.
Well, I'm not well suited to answer that because I'm like one of the least risk averse people, a lot Canadian. I'm certainly amongst the most least risk averse Canadians. So I'm not well placed to answer that question. So I'm going to just defer to Janet on that one.
So I think in terms of, if I understand the question correctly, I think the hypothesis is, hey, Canadians are more risk averse, and so will this change it? I mean, I don't think that this environment is going to make Canadians less risk averse. I do think what's interesting, as somebody who absolutely loves all Canadian entrepreneurs, is that I think that Canadian entrepreneurs, frankly, are better positioned to weather this storm in general. It's a huge generalization, than US investors. Interestingly enough, last week I was speaking with an investor who does a lot of investing in the Valley and elsewhere. And he made the statement to me, he said, I am finding it very difficult to get my Valley-based founders to cut their costs quickly. And he said, I'm finding founders elsewhere understand what this problem is, and they're very quickly cutting the costs. And the founders that are based in the Valley are, I mean, maybe they are, more risky. They're bigger risk takers. And I think, anyways, it'll be interesting to see how that plays out, and whether the Canadian, I think that a lot of Canadian companies have generally managed their cash much better. I know that when Canadian founders go down to the Valley, a consistent feedback that they hear is, wow, you've done so much on so little cash. Canadian entrepreneurs have tended to think about getting to cash flow, break even, and or at least positive unit economics sooner than Valley-based entrepreneurs that tended to focus primarily on growth. And so I think while Canadian founders often are given a bad rap because of those factors, I think that in a situation like this, it will serve them well.
I think, Laura, too, one thing that might be helpful is just, I think, to frame, some of what we're saying in a positive light, where, these are often the periods where a lot of to Janet's point, a lot of the really great businesses end up being born because, we've come out of a market where in a lot of ways hubris has been rewarded. And kind of, if you think about the three pillars that Janet was talking about, I would say in some ways, hubris was in some ways more rewarded than management in a lot of cases. And there's a lot of really great companies that, have really strong teams that have some amount of cash or have taken pay cuts or will just figure it out, over the next 6 to 12 months. And I think that, those will end up being the companies that, will be very investable, in the future. And, there will be companies that don't survive that, but then the companies that do are going to be there. And I also think that, we will see the market return at some point, in the next year to some degree, in some way, shape, or form, whatever that looks like, potentially. But, I'm personally thinking about really using this window as a window of refinement, which is, how do we manage our costs and bring them down as closely as we can? How do you think about bringing your core team? Really hard thought around what that core team is. How do you stretch every dollar the farthest? Because if you do that now and you do that well, from a long-term perspective, you might find in two or 3 years from now, you're actually further ahead than you would have been if you wouldn't have taken that time and taken this pause, which no matter what industry you're in, it seems like it's a pause unless you're in healthcare or one of those areas, or you're in warehousing and logistics. For lots of us in software and ed tech and talent, whatever else, it's very much a pause that gives us an opportunity. And I think being as hard on your costs as possible is definitely the key. I don't want to say the Canadian key to survival, but it's definitely a key that is very important because, I've talked to a lot of founders in the last while whose net new sales have just really slowed. And, it could be 6 months before they ramp back up. And the time period from slow to ramp back up, they're paying everything. It's just going to be really, really difficult for them. So, I think aligning your strategy with reality is incredibly important. And then, making sure that as a leader, you're keeping your mindset focused on, what you're building towards, because that's ultimately going to be what gets you through this in a positive way on the other side of it.
Okay, thank you both. So we're going to move to one more question from the audience, and then we're going to try to do some lightning round questions if we can, because we just have so many things coming in. Our next question is going to come from Josh Dominguez, the founder and CEO at Flash Food. And so Josh Dominguez, we are finding you and unmuting you. We've got your question here. I want you to ask it as quickly as you can. Thank you.
Sure. Yeah, Josh Dominguez from Flash Food. I'm calling in Toronto. Basically, to summarize my question, what are things that you see that change in term sheets or financing rounds coming out of situations like this? So what terms were in before and what terms change from investors coming out of this?
Sure, I can take a stab at that. I'd say that sort of vis-a-vis liquidation preferences, the norm. I haven't seen any exception to this over the last number of years. It's sort of a 1x non-participating preferred liquidation preference, which basically means that there's not sort of a senior preference stack for the venture investors. I think that might change in a wide swath of fundraising rounds for companies where the previous investors invested in a very different environment. If investors are stepping up in this really uncertain macro environment, they might want sort of a 2x or maybe even 3x liquidation preference, which would be a significant change from what we've seen over the last number of years, arguably like decade. I will note that sort of preferred liquidation preferences occasionally occur in very late stage growth rounds, even in good times. But I think we're going to start seeing those get pulled earlier. That would be one. Two is I think down rounds and recaps are going to become a lot more common. We're currently considering leading a down round for one of our own portfolio companies. So I think that is, and I know many other companies, friends that are entrepreneurs, friends that are VCs, I think sort of down rounds are the new flat rounds and flat rounds are the new up rounds or something like that. And so there is this sort of valuation reset that's going to play out over a number of quarters. And then finally, sort of the general, I'd say that VCs will be generally biased more toward control than they have in the past. So things like board seats, the ability to block, the sale of a company, not necessarily being pari passu with prior financing rounds. Those are all things that, as a general rule, investors are going to feel like they have leverage to try and get more control, which is sort of contra this hyper founder-friendly environment we've been in. And as an entrepreneur, I think you want to push back very strongly against the sort of VCs that want sort of the weird control stuff, like controlling the board, being able to block, a liquidation event. You want to push back very strong on that. And then I think you need to be opportunistically willing to give on the sort of financial terms, but you need to be very firm on sort of not ceding control to the investors. That'd be sort of my advice for entrepreneurs.
Thank you, Geoff. I mean, the thing I would add is that I think that in a lot of situations, and by the way, Josh, it's great to see your friendly face. But what I was going to say is I think that you will see the true colors of VCs come out. Just like in hard times, you see the true colors of people. And you will see some VCs that take advantage of a company that it needs money and they will push to do punitive pay-to-play rounds and other things. And you will see other VCs that step up and say, hey, we want to invest and we want to invest on fair terms. And so I think that this is one of the times where you will see the true colors of the VCs and hopefully your VCs around the table will act in a way that sets you up as a founder and as a firm for long-term success.
Great point. I would just add one thing, which is that I think the challenge in practice, so it's a very good conceptual framework, and I think the challenge in practice is there's going to be a disconnect between what investors and entrepreneurs view as fair terms for like a while. So I think there's going to be a disconnect. And so sort of now working with people who you really like, where you can have honest conversations, sort of navigate that disconnect to get to an agreement on what's fair is really important. It's going to take a while to work through the system.
Great, thanks. We're going to go for one more, and we're going to flip it over to Emile Mamery, co-founder of Steadyware.
Hello.
Yep, you're on,
Can you hear me?
Emile. Yep.
Hi, this is Emile from Steadyware, based in Toronto, and I had a question particularly about for companies that are hardware based. We're also medical devices, and until now, all our funding to date has come from government grants or competitions, and we were just about to open a funding round right in time for Health Innovation Week. Unfortunately, Health Innovation Week was delayed, and given the fact that we hadn't been fundraising beforehand, we were kind of sidelined by that. So we applied for the BDC funding. We weren't able to get it because of us receiving a BDC loan prior to that. But I was wondering if there's any form of other funding that you would suggest, or any other strategies that would allow us to, tap into some more funding for a hardware company who really needs more inventory to scale and grow.
So I guess I'll take that. In terms of funding for inventory, if you're exporting, you should look into what EDC is doing. I know some of our companies that are in the hardware that need money for inventory are looking at EDC has come out with some new programs. So I would suggest that and seeing if you can get funding that way. Another option that you may want to look into is, depending upon your business, don't know enough about it, but in some cases now you may be able to get money from strategic investors. It cuts both ways. In some ways, generally I would say, hey, strategic investors are not necessarily the investors of first choice for an early stage company. However, and they usually move slowly. However, at this time when VC funding is definitely less readable, we are seeing some of our companies have some success with strategic investors.
That's a great answer. Thank you, Janet. Mike, we're going to wrap up here. So any closing thoughts from you would be awesome.
Well, thank you, Laura. I really appreciate Janet and Geoff joining us today. I think the insights here were incredibly helpful. And as a summary, I think thinking about the fact that you've got to get to each 24 months of runway is really important. Obviously, that you need to explore whatever cash you have, whether that's access to pulling venture debt, whether that's cutting costs to increase your runway, but really looking and thinking about that. And then making sure for whatever market you're in, you've got a concise plan. I know I'm happy to, if anybody has any additional questions, happy to ask them on LinkedIn. I'm sure Janet and Geoff are happy on LinkedIn or email as well. If there's anything that we weren't able to get to today, I can do my best to sync up with Laura after and coordinate any of the answers as well. But we're all going to get through this. I know, depending where you are in the world and where you are in the cycle, we're kind of at the very beginning of the roughest patch here in New York. But there will be a light on the other side of the tunnel. Great companies will survive and continue to be funded. The world will go forth. And I was texting a friend last night whose business was somewhat challenged, and I think the brief synopsis is that this is just, think about this as a really good opportunity to refine what you're doing, to build it towards what you really want to build and where you want to go. And it's a time where you have the air cover to make the really hard decisions. If you need to cut your team by 90% to focus on what you want, and you weren't quite there, you can do that. You've got that air cover. So, I think find the positives to find the cash that ultimately builds whatever you're trying to do. And I've got no no concerns over a lot of really great companies coming out of the people that are attending and ultimately the portfolios, everybody on this call. So thank you very much for joining us today.
Thank you all so much. Take a look in about 2 hours. We'll be sending around the summary. We'll also have a way there for you to contact the panelists. I'm seeing a ton of great advice, book recommendations, etc. in the chat, though I'm not sure it's all going to all attendees. And so we'll do our best to find a way to collect all that information as well. Janet, Geoff, Mike, thank you so much for your support of Canadian Founders, and of course for your commitment to C100 as well. We could not do our mission without people like you, so thank you so much.
Well, thank you very much for
Thank you,
having us
Laura.
on. And to all of the entrepreneurs out there, you're doing a great job. Just keep going, persevere, make the hard choices, and we'll all get through this together.
Hang in there. And if you're a Canadian entrepreneur in the US, you may want to consider relocating your company to Canada. Now it's probably a good time.
Yeah, that's a different call. We should actually do the how to relocate to Canada call. Yeah, I know.
All right. Thanks, everyone.
Thanks.
Bye, everyone.
Bye.
Bye.